This is the single best chart to get us to August, 10 years on from the financial crisis. Financial crisis right here. We have never seen orthodox economics so far from where Chair Yellen is. This is the Taylor rule. And through the fog now, we look at the putting green. The dots are out here somewhere. Good luck with that. With us, John Ryding of RDQ Economics, who stopped surveillance traffic in 2007 with the illusion of a golf course. And I believe it was Chairman Bernanke at the time, I can't remember, out on the putting green. Does Chair Yellen have a clue where the putting green is today?
Well, actually, it was 2004, and it was about the Fed keeping rates too low at the time. Now, at the time, we feared the possibility of inflation. It turned out that the very low interest rate policy, which back then was 1%, and very slow gradual rate increases, laid the liquidity foundation for the financial crisis that people didn't see coming. So now, who's to say that the Taylor rule is the right number with the assumption of a 2% real rate? But even if you take the assumption of close to a 0% real rate, interest rates are still too low. And on top of that, that chart doesn't take into account the $4.5 trillion balance sheet the Fed has.
Go back to the chart quickly here. I want to show 2004, which is this odd, the white line, the low rate of 2004. I believe President Trump is going to be able to appoint someone like John Ryding or John Taylor or whoever to run the Fed. Do we need a new rules-based Fed so we know the rules of the golf course, so we know the rules of where the putting green is, or is discretion still valid?
I think central banks will always have to have discretion. The question is whether the discretion is guided by some underlying principles that the market can follow and understand, or whether the central bank simply keeps moving the goalposts. Let's go to rather than the putting green, let's go to that football analogy, moving the goalpost. So the Fed has laid out goalposts, and then when we've seen us get close to the goalpost, there has been a tendency to move them. But I think that this time it's different, that the Fed is very serious about starting to reduce its balance sheet, possibly as soon as the July meeting. We'll find out more this afternoon. Our call has been September for the longest time, but I could see them starting the balance sheet wind down in July, because that's going to be a 5-year or longer process, and that they'll continue to nudge interest rates higher. So at least this gap is telling us where rates, at least directionally, are headed. Yeah, sorry, Francine.
But John, the thing is that central banks haven't been held by politics, right, at all. If you look at central banks' language, they've been asking for structural reform or fiscal help for a long time. Will they get it now?
Well, in the Fed's very careful about not asking for anything outside of the realm of monetary policy. So I think that's much less of an issue here in the U.S. Now, of course, we had been expecting, when the president was elected in November, that there was going to be large fiscal programs, particularly tax cuts and infrastructure spending, and those, whether we get those now, I think, is somewhat a question, or at least when we will get them, because everything's backed up behind healthcare, and healthcare doesn't really seem to be going anywhere at this point in time. Europe's very different. Europe does have a much more rigid labor market, and that structural reform, I think is needed. And I'm not an expert in the area of structural reform in Europe, so I won't venture much further on that. But the Fed doesn't need the help from other policymakers at this point to get on with the job of reducing the balance sheet.